How is everybody doing? You are in the strategy room. It is Saturday night, January 18th, 2025. You're here with the banker next door, Dr. Joe Berquist. I hope everybody's having a great night out there so far. But I wanted to just start with this. I just want to wear my little I'm wearing my little T-shirt here for the Air Force Academy, Space Force. Give a little shout out there to the great men and women over there at the Air Force Academy in Colorado. Wishing you guys nothing but the best. I'm a little dressed down today. Look, got the hoodie going here. It's cold here in Pennsylvania this week, so so I figured I would keep in that motif, and we would just get rocking and rolling with this. So okay, so I've got a ton of stuff for everybody tonight. So I hope everybody just kind of sits back and relax, and we're going to get to a ton of stuff in just a minute here. As Delilah used to say, sit back. Does everybody remember Delilah? I guess you'd have to be of a certain age to know Delilah, but I think she just ended. She was on the radio for, I don't know, 30, 40 years. And I think she just ended her run, but she was always with the smooth voice and the sit back and relax. You're in here with Delilah. But anyway, not quite that relaxed, but all right, we'll get in here. All right. I'm going to open up here tonight with our good friend, Janet Yellen, who just left, just stepped down. And, Janet was so nice. She was so good. She loved us so much that Janet, the secretary, announces that the U.S. will hit the debt limit on Tuesday, January 21st. Yellen has advised the U.S. Treasury to start extraordinary measures. Oh, that was so nice of her to leave us with that giant, what sandwich there at the end as she walked out the door. And this was on the heels of the last week when she said, Janet Yellen says trillions in COVID spending over a short period of time may have actually made some prices go up just a little bit. Might have just been, Janet transitory Yellen. It might have, inflation might have been caused there by the government spending all that ridiculous amount of money in just a few short years. Just maybe. Janet has not done us any favors here. This is just I don't know. I mean, could this be a catastrophe? It could. I mean, this could be a major problem here and could cause some major turmoil in the markets over the next couple of weeks. I just want to show you guys a couple of things here. Where am I going? Okay. A bond sell-off is rocking the world. You might want to take the other side. A rare bear steepening trade is pressuring governments and worrying investors. So Wall Street is really worried about bonds. It might be time to buy some. On Friday, a jobs report that blew past expectations pushed yields on 10-year treasuries to 4.772%, the highest close since November 1st of 2023, and those on 30-year paper to 4.962%. What is spooking markets, however, is that much of the recent rise in yields doesn't appear to reflect expectations of stronger economic growth. Rather, it might be the result of investors applying a higher discount or term premium to hold long-term bonds. Estimates by the Federal Reserve suggest some analysts attribute this to the possibility of Donald Trump's promised tariffs derailing the global economy and leading to a jump in inflation, while his tax cuts bloat budget deficits further. Movement in term premiums are usually strongly correlated across the globe, and the consequences are being felt more starkly in weaker economies overseas, especially in Britain. There, the 30-year yields are trading around 5.4%, a 27-year high. We're going to get back to that in just a second. And then we also have France is also in the hot seat. And a further sign of trouble, the pound and the euro are falling. For one, the fiscal doomsayers are probably wrong. Countries that print their own currency can't truly be pushed to default. More important, inflation-linked treasuries have sold off too, bellying the idea that markets see a hot economy and tariffs as a serious inflationary problem. It might all have to do with the interest rates after all. Since December, the Fed has squashed expectations of a prolonged rate cutting cycle. As a result, the whole middle part of the Treasury yield curve from 2 to 5 year maturities has become positively sloped for the first time since 2022. Only the very short end from 3-month to 1 year remains inverted, reflecting the 1 or 2 cuts that markets suggest might still happen this year. The reason alarm bells are ringing is that longer term bonds have sold off even more, a bear steepening trade in Wall Street lingo. 3 out of 4 times yield curve steepened for the opposite reason. Historical data shows a fall in short-term yields driven by central banks cutting rates very fast. Bear steepenings follow a period of inverted yield curves are rare. No, they're not. And mostly are reminiscent of a stagflation periods of the 1970s and 1980s. So I want you to keep all this in mind. I'm reading all this to you here for a very specific point. So let's go back here for a second. If I can find this, what I'm looking here for here. Do we have it here? Can I find it? No. I was looking for something on, there was a chart I had here on the yield curve, which I wanted to show everybody. So the yield curve, I'll find it here in a second. Just bear with me here. That's repos. Nope. Budget. That's also related here. First time in history when 100 basis points of rate cuts raised 10-year yields by 100 basis points. Yeah, first time in history. Look at that. That's it. That's interesting, isn't it? 100 basis points yield cut, 100 basis points cut by the Fed, and then 100 basis points straight up. That's interesting, right? All right, man. I'm not finding this yield curve chart that I was looking for here. I got all this repo stuff, but I'm not finding the yield curve thing. I had it in here, and I'm not seeing it. But anyway, the point I wanted to get to here, if I can get back to this bond sell-off here, is that, this is the, again, they're trying to say here that, some analysts attribute this to the possibility of Donald Trump's tariffs derailing the global economy and leading to a jump in inflation while his tax cuts bloat budget deficits further. No, that's not what is happening here. What is happening here is that Janet Yellen pumped the Treasury. She took all the money out of the Treasury account. She's basically left us with no money. We've hit a debt ceiling. And and now we've got this horrific situation. And now the yields she artificially kept the yield curve inverted for the longest period in history, for like 786 days. And now we're coming out of it. Now, to be fair, the yield curve reverting from an inverted to a sloping yield curve or a normal yield curve, it's not a perfect indicator of a coming recession, but it's like 95% accurate. And this, and I was really troubled by this article here because I felt that it was very disingenuous, basically saying like, oh, well, the yield just reverted to positive territory, but that doesn't really mean that we're going into a recession, that just, because that doesn't really happen. Like here, 3 out of 4 times yield curve steepened for the opposite reason. Historical data shows, a fall in short-term yields driven by central bank rate cuts very fast. It's just not like that's not true. That's not historically true. What happens is usually when you come out of an inverted yield curve to a sloping yield curve, a positive yield curve, usually the recession is going to follow that in about 3 to 6 months. But you cannot underestimate the amount of manipulation that Janet Yellen has done over the last 12 to 18 months. And it's horrible. And I just am dumbfounded by this situation that she's left us in, and I almost found it gross when she was leaving. Yesterday, when she was leaving the Treasury building, wherever, and you had all these people out there giving her a standing ovation. Oh, yes, Janet, you did such a great job. She was a horrible Treasury secretary. Horrible. Might have been the worst Treasury secretary we've ever had. And here's the thing: not because she was an idiot. No, that's not because of that. This is because she turned into a political hack, and she basically was just doing all this stuff to, stick it to the next administration, for lack of a better word. And it's horrible. And I just cannot fathom that, this is the situation that she dumped us into. So I'm still looking for this. I'm going to find it here. I'm going to find this. Be patient. I'm going to find it. Oh, this is kind of funny. Here we go. The economy is going great. We created 5 million jobs this year. I have 3 of them, and I still can't pay my rent. that's there it is. There's the truth right there. I think we're getting close here. Now, here we go. So here's one of the things I was looking for right here. So let me get this a little bit bigger here so everybody can see this. Okay, so when Joe Biden and Janet Yellen arrived in January of 2021, they had 1.6 trillion in cash in the U.S. government bank account. They're leaving Trump with only 600 billion, and the debt ceiling preventing Trump's administration from borrowing anything. This was done intentionally. Yes, there you go. So she drained out $1 trillion in cash just in the last year. And now she's leaving Trump with $600 billion. And basically they can't borrow anything because the debt ceiling, of course, hit perfectly the first day of his new administration. That debt ceiling hit. So you're telling me that wasn't done intentionally? I mean, you just can't make this stuff up. Yeah, Trump is being handed an economy with declining tax revenues and rising expenditures, hence the exploding deficit. It's a disaster. October to November 2023, the budget deficit was 380 billion. October and November 2024, the budget deficit was 624 billion. I cannot believe I still can. I had this chart all teed up around. I'm really upset about this. I had this chart all teed up and ready to go, and now I don't have it. So, all right, we'll come back to that. But the point is that Janet has really jammed us up here, and it's put us in a horrible spot. And I'm just glad she's gone. I'm glad she's gone, never to come back. Janet Yellen has just left the office. Thank goodness. Goodbye, Grandpa Janet. Go home. Go knit some yarn or whatever you're going to do there on your porch. Just had enough of that. Millet, my boy, my man. We're going to talk about him a little later, but we're going to leave that for right now. So, okay. What I want to get into here is bank stocks outperforming in first week of earnings. So that we kicked off basically earnings season this week. U.S. bank stock outperformed the broader market as the industry reported earning results for the fourth quarter of 2024. The KBW Bank Index rose 4.2% from January 9th to the market's close on January 16th. The S&P 500 rose 0.3% during the same period. And then total return calculated here over the last week. We can see Franklin Financial Securities, best performing stock, Unity Bank Corp, Meridian Corp, Home Street, Northeast Bank, all doing very well. The first, second week of the year here. Hawthorne Bank Shares doing the worst. First Capital Inc., John Marshall Bank Corp doing not so great there, following it up. So why am I talking about? So why are we looking at bank stocks here to start the year? So I want to read this guy from it. I want to read this to everybody here. So this is from Naomi Snyder, editor in chief for Bank Director. And this was called Underperformers No More. Investors finally got excited about bank stocks in 2024, particularly toward the middle of the year as the Federal Reserve began signaling cuts to interest rates. The NASDAQ Bank Index rose 16.7% during the year, compared to 10% growth in the broader market index and the Russell 2000, according to Piper Sandler and Company, for the past decade. Low interest rates and uncertainty about credit have kept bank stocks prices low compared to broader indexes, especially the S&P 500. Banks are cyclical, said Frank Schiraldi, managing director and senior research analyst at Piper Sandler. They're feast or famine. The year 2025 seems ready for a feast. The market has priced in expectations for better earnings in 2025, hoping for improved loan growth as lower interest rates lure borrowers back to investing in their businesses and applying for loans. Hold on to those comments, because we're going to look at some stuff here in just a minute. We're going to see, where the year's not already off to a great start. The Fed began cutting rates in September. Donald Trump's election also lifted bank stocks amid hopes of a lighter touch on regulation, according to Jeff Davis, managing director of the Financial Institutions Group at Mercer Capital. But a lot could still go wrong. Yes, indeed. If higher rates of inflation return, or banks fail to meet analysts' expectations for improved earnings, bank stocks could easily retreat. Already, stock prices for the Russell 2000 and the NASDAQ Bank Index have fallen a bit in the new year by 2.5% and 4.3% respectively as of mid-morning Friday. We just have to see the banks deliver on earnings, Davis said. I'll put investors in the category of what have you done for me today? Publicly traded bank stocks remain relatively inexpensive, with the bulk trading at about 11 to 13 times forward earnings based on 2025 consensus estimates, Davis said. Compared to tech companies, which often trade north of 20 times forward earnings, bank stocks seem like a good deal. But banks haven't had an easy time competing with tech companies for investment dollars. Technology has been a black star as it relates to investment capital, Davis said. It has absolutely sucked money in, and it has pulled money away from bank stocks, retail, REITs, and industrials, and the like. So the expectation there is that if interest rates would come down and that the Trump administration would basically back off of regulation stuff like that, that bank earnings could be pretty good for this year and that bank stocks might go up. So what we've seen here in the first couple weeks is a little bit up and down, but a good week for this week. We get into like best performers and then worst performers, and I think we have that. But just something to keep an eye on here, and let's keep going here. So what are some of the things here? What was some of the news here this week that was affecting some of this? Well, we had retail sales. December 2024 U.S. retail sales missed forecasts. The U.S. consumer retail spending in December 2024 slightly underperformed economists' forecasts, even as spending climbed both on the month and the year. December total retail and food service sales in the U.S. rose 0.4% month over month and 3.9% year over year, according to adjusted U.S. Census Bureau data. The sales growth from November missed consensus estimates of a 0.5% gain, according to data compiled by Econoday. However, November sales were revised up in the latest Census Bureau data, now showing a 0.8% increase from October, compared with the initial estimate of a 0.7% increase. Consumer spending during the month capped off the October through December holiday shopping season, during which cumulative sales climbed 3.7% from the same three-month period in 2023. S&P Global Market Intelligence recorded 3 new retail bankruptcy filings with liabilities over $100 million from December 13th to January 15th. Default risk for publicly traded retail companies rose slightly during the same period. But then we get into retail food and services sales hit a combined $729 billion in December. For the month, consumer spending grew in 10 of 13 retail food service categories. And we can kind of see from this chart here, retail, non-retailers, health and personal care, personal and clothing, food and beverage. December saw a strong year-over-year increase in spending at durable consumer goods retailers like furniture stores, electronics and appliance stores, and motor vehicles and parts dealers. This could be consumers replacing possessions damaged in Hurricane Hilton and Helena, or stronger sentiment in late 2024, unlocking discretionary spending, or a combination of both. And then we get the announcement here, U.S. retail bankruptcies definitely edged up here in 2024, up to 35. And we've seen a number of them. Joan just declared bankruptcy for, I think, basically the second time. The Container Store, Party City, Healthy Spot Operating LLC, EnviroScent, Universal Screen Arts, Big Lots. Yeah, a lot of retailers, a lot of big name retailers, filing for bankruptcy here. We got some default risk. So overall, numbers not too bad, but just like I said, Wall Street disappointed there a little bit with that. But I think the bigger thing, the more concerning thing, is the retail bankruptcies. Retail bankruptcies. Do we still have more stuff to come out and happen there? We shall see. So, okay, then we get into headline inflation growth moves away from Fed target, complicating next step. So annual headline U.S. inflation growth has crept back up in the 3 months since it fell to its lowest point since early 2021, and is now decidedly moving away from the Federal Reserve's policy target. So like I have been saying for the last couple of months, inflation is back increasing again. Inflation is not moving toward the Fed's 2% preferred inflation target. Like I said, it has basically parked itself in the 2.5% to 3% range. And here we go. The headline consumer price index, the CPI, grew 2.9%. From December 2023 to December 2024, the highest reading since July of 2024, and the third straight month of higher inflation growth. The Bureau of Labor Statistics reported January 15th. The Fed wants inflation growth to slow to 2% annually, though its preferred measure is the Personal Consumption Expenditures Index, with volatile food and energy prices stripped out, also known as core PCE. Still, the latest consumer price index reading is likely to complicate the Fed's monetary policy path forward, and is already causing unease amidst investors bracing for the potential price impacts of the incoming Donald Trump administration. The Fed is undoubtedly growing increasingly concerned about the stubborn inflation figures of late. Yes. And and you can see here from this chart, we're here at 2.9%. And while inflation has come down, it has stopped retreating. That's the problem. Inflation has stopped retreating. And you could basically make the argument that the reason why the Fed's prices have, been on the rise here for the last 3 months is because the Fed has been cutting rates for the last 3 months. And now with the rates going down, it is spurring inflation to pop back up. It's the same mistake they committed in the 70s. If everybody remembers, going back to some of the live streams from last year, I talked a lot about inflation. I talked a lot about the yield curve. I talked a lot about what happened in the 1970s. I talked a lot about, just what had happened there, and a lot of the mistakes that the Fed had made, and that I was really concerned that the Fed was going to continue making the same mistakes again and again. And this is a big, this is the big concern, the big problem. I felt like that the Fed cutting rates was actually a big mistake, that it could actually spur another spike in inflation. And while this hasn't exactly become like a spike in inflation, the problem is inflation is, it's not going to hit their 2% target. It's not. And it's starting to creep back up now. So I think the Fed is definitely now in a spot where, unless we start getting the real unemployment numbers, they're not going to be able to cut rates. They're going to have to just sit pat with where they're at and see what happens. And then here we could just see some of the other inflationary data, year over year inflation in December 2024. We could see energy, fuel was down, other motor vehicles was down, gasoline was down, but look at eggs. Look at eggs, 36.8%. I think now if you go to the food store, What 18 eggs cost like $10, $11. I mean, it's crazy. 36.8% for eggs. Frozen non-carbonated juices and drinks, 12.5%. Other condiments, 12.4%. Uncooked beef roast, 7.1%. Uncooked other beef and veal, 6.8%. Commodities, college textbooks, 8.9%. Recorded music and music subscriptions, 7.8. Cigarettes, 7.8. Men's pants and shorts, 6.1. Boys apparel, 5.7. Video discs and other media, 12.3. Pet services, 11.5. Motor vehicle insurance, 11.3. Postage, 10.6. Care of invalids and elderly at home, 9.5%. I mean, so it's just, it's crazy. The rate of inflation here. And then wages growing slower than consumer prices. Yeah, no doubt. No doubt. All right, let's keep going on here. So more bond market news here. So U.S. bond market sell-off shows no sign of stopping. And this was from Tuesday, January 14th, so from 4 days ago. The benchmark U.S. government bond yield has surged more than 110 basis points in mid-September last year, as expected interest rate cuts have been upended by persistent inflation and concerns about the incoming administration's trade policies. The 10-year yield settled at 4.7% on January 10th, its highest settlement since November 1st, 2023. The 30-year Treasury yield has jumped 102 basis points since the middle of September, settling at 4.96%. With inflation rising toward 3% annual growth rather than falling toward the Federal Reserve's 2% growth target, Fed officials have lowered their expectations for rate cuts this year, largely pushing up bond yields, which move opposite prices. With President-elect Donald Trump's expect to push forward aggressive tariffs and other policies likely to raise domestic prices, the surge in bond yields is likely to persist. Based off this, there is no material reason for the 10-year Treasury yield to fall. However, again, my argument is that this does not have as much to do with Treasury as much as these guys would love to now, shift gears and just blame everything on Trump. That's not what this has to do with. This has to do with the national debt. It has to do two big things, the national debt, and it has to do with what Janet Yellen did at the Treasuries with her manipulation of short-term Treasuries. She has now left us this situation where $7 trillion in treasuries are going to have to be rolled over this year. When those get rolled over, it is going to force the yields higher. So, and that has nothing to do with tariffs. Like tariffs, all right, if some of that stuff on tariffs comes true, you could basically consider that the icing on the cake, but not the cake itself. The cake itself is the national debt, and it's the nonsense, the just complete nonsense that Janet Yellen did over at the Treasury. That is what is causing this to spike. And then here's a great chart, and this is very similar to what I was looking for earlier, and we just found it here. So here is the inverted yield curve. After more than 2 years of inversion, key portion of yield curve reserves fast. 10-year Treasury minus the 2-year Treasury. So you can see here, we were finally allowed here, basically starting back in August, to begin to approach back over to positive territory. But here, going back a year to the end of 2023, where it almost went positive here, this is where the manipulation of Janet Yellen really kicked in. When it started to go back positive, she stepped in and was like, and do you remember the chart I just showed you, going back, looking at the cash in the Treasury account going from 1.6 trillion to 600 billion, $1 trillion gone. That's where this money went. It went here to keep the yield curve, to keep this yield curve inversion going. And then finally, after all, they blew through all that money and put all that money into short-term, treasuries. Then they let it go. Like, okay, we held it down long enough, and now, okay, we're gonna let it roll. All right. So let's keep rolling here. All right. So now keep in mind, what have we been talking about so far here? Now I want to start to bring some of this stuff together. So we were talking about bank stocks. We were talking about, treasury yields. We were talking about interest rates. We were talking about bank earnings. So how are things starting the year off? And now let's take a look. So bank lending rebound on hold. Wholesale borrowings down in the fourth quarter of 2024. So another soft period for the U.S. bank loan growth in the fourth quarter of 2024 has analysts looking toward the second half of 2025 for a potential rebound. Seasonally adjusted loans across domestically chartered commercial banks increased 0.6% from September 2024 to January 1st, 2025, according to weekly data from the Federal Reserve. Without seasonal adjustments, the increase was 1.2%. Bank loan growth has substantially lagged economic growth for about 2 years. And one potential catalyst, a conclusive result of the presidential election, did not have an immediate impact. Year-over-year growth in loans and deposits has gyrated wildly at domestically chartered commercial banks since 2020, reflecting pandemic imbalances and major shifts in interest rate environment. For deposits, growth peaked at 24.3% before going negative in 2023. And for loans, a contraction was followed by peak growth of 11.5% in late 2022. Since April of 2024, however, year-over-year growth in loans and deposits has converged in a range of 0.6% to 3.2%, with deposit growth a bit better than loan growth from September to mid-December. Loan growth has not kept up with GDP in recent years as pandemic-era stimulus and recovery distorted the relationship between the two. B of A global research analyst said in a June 7th note, we expect loan demand to pick up by the middle of 2025 to the second half and into 2026 on the back of a Trump policy agenda that is expected to encourage domestic capital expenditures. So yes, and we could talk about the funding side, but I'll hold that off for a little while. I don't want to really get bogged down into all that, but lending, as far as lending is concerned, interest rates are what is going to ultimately drive lending. And here's what's really fascinating about the interest rates. Right now, I would say your commercial rates probably sitting, again, depending on the type of deal, the size deal, you're probably looking somewhere in the neighborhood of 7% right now on like a commercial mortgage loan. Residential mortgage loans, I think, are over 7%. I'd have to look at the number points. I know they kind of whipsawed a little bit this week. They were kind of up and then down over the last couple of days of the week. But the point being is that people got so used to the ultra low rate environment. They got so used to the 3.25, 3.5, 4%. Even 4.5, 4.75, they got that. That's where rates were for a number of years. And people really got used to that ultra low rate environment, and real estate went up, values increased. But if you could think about it in terms of like cash flow on investment properties, everything was geared around that 3.5, 4% interest rate. Now rates have gone, like I said, back up to 7%, which is not historically that 7%. When you go back over a much larger time horizon, if you were to look at a chart of interest rates over, say, the course of 50, 60 years, you would see that interest rates are basically in a normal range. Like a normal bandwidth range for interest rates is basically 7 to 8%. That's just a normal range. So in a very real way, what we've gone back to is just normal interest rates. But there's two big problems. Part of it is it's a psychological barrier. Like the Federal Reserve they distorted the market so bad. And here's a great opportunity for me to plug the Lords of Easy Money series. If anybody has not, I did a whole review of the book, The Lords of Easy Money. Go to the channel site on YouTube, scroll down. I have everything, broken out under different playlists, different categories, but find the Lords of Easy Money playlist, go through, listen, that, like I said, the book is incredible. It breaks down everything that the Fed has done over the last 15, 16 years. You will understand after reading that book why how badly the Fed has distorted this market and all of the problems, everything that they have created here. And one of those big problems was they kept rates too low for too long. They did too much quantitative easing. They printed too much money. They bailed everybody and their mom out over the last 15, 16 years. It's what I call the all bailout all the time economy. That's what they have created. And and it's tough. It's very tough because we now have this psychological barrier of going above, say, that 5% threshold. Anything over 5% seems like astronomically high, and it doesn't work on a lot of deals. And think about the consumer market. Your Ford F-150 truck costs anywhere from $70,000 to $90,000, right? That's a huge amount of money to pay for a pickup truck. How many people? I keep asking the question. I go to these car lots, and GMC, Ford, and you walk around and you see like the cheapest car on the lot is like $40,000. And your higher pickup trucks are $70,000, $80,000, $90,000. You even have vehicles over $100,000. And I say to myself, how many people realistically can afford these vehicles? Okay, they'll give some specials, maybe some lease deals, or maybe they'll have some 0% financing offers or 1.9 financing or something like that. But there's also a lot of people that are paying much higher rates. They're paying this 7, 8, 9% interest rate now to buy a vehicle, and that's just bludgeoning people with the higher values of these vehicles. In other words, back in the 70s and the early 80s when this stuff hit, it wasn't, in a certain respect, it wasn't as catastrophic because, okay, your new car might have cost you $8,000, $10,000. And so if you had a 7%, 8% interest rate, it wasn't the end of the world. Now with that vehicle costing $80,000, 7 or 8% interest rate, that's a huge number on top of your interest, right, to try to pay for that vehicle or that house. So again, the psychology there is a big factor. But then the other thing is, just like I've been saying, how the interest rates affect the financing of things. Again, when you look at that investment property on commercial real estate, you put the interest on the debt in at 4%, deal works fine. You put the number in at 7%, all of a sudden, property's underwater and you have negative cash flow, and deal doesn't work. And everybody in the banking has seen, people on the commercial side of banking would know, seen a lot of those deals in the last year, seen a lot of those deals. And all of a sudden, you want to do deals. Everybody wants to do, realtors want to do deals, buyers and sellers want to do, everybody wants to do deals, but you punch the numbers in and they just don't work. So that just takes time to regulate in the local economy. It takes time. Buyers and sellers have to find an equilibrium. They have to understand, everybody's been, keeping their fingers crossed and hoping that rates were going to come down dramatically. And the Federal Reserve was getting ready to do that until, we've seen this craziness in the bond market and the treasury market driving the yields back up. Like that one chart I showed you earlier, first time in history that the Fed cut 100 basis points and the treasury yields went up 100 basis points. So basically the Fed's action was completely negated because of the increase in the treasury yields. So rates on fixed rate stuff have not moved. And this has been the biggest, again, a lot of customers are, they're not understanding. They're, people are calling up the banks, I'm sure, and I'm sure a lot of people can sympathize with this. And that is, you get the phone calls and they're like, oh, hey, I wanted to look at doing this deal now that rates have come down. And you're like, yeah, no, the rates haven't come down. And they're like, well, what do you mean? I've been watching the Fed cut interest rates by 100 basis points for the last 4 months. Yes, you have. Rates haven't gone down, though, because the Treasury yields have shot up. So it's basically completely negated, what the Fed was trying to do. So if inflation is high and the Fed cuts rates and drives inflation up and the Treasury yields just keep going higher, why is the Fed cutting rates? I mean, it just doesn't make sense for them to cut rates anymore if that is the reaction that they're going to get. And I think, unfortunately, people are just going to have to settle in now to the reality that these rates are much higher, and we are not going to go. We're not going back to 3%, 3.5%, 4% rate like that. We are not going to see those rates, and it may be a long, long time before we ever see rates like that again. And that's going to be an issue because the economy is going to have people, and the economy, they're going to have to adjust to this new economic reality. They've been kind of holding it off, for the last year, but I think the reality is finally, it hurts, and this is going to hurt loan growth, at least in the short term. The hope, like these analysts said, is that we can rebound the second half of the year, but we'll have to see. We'll have to see what happens with that. Okay. Keep going here. Some of the other things here. Fed rate cuts to have limited impact on regional banks' fourth quarter 2024 earnings. So what we were saying, the bank stocks, the hope was that earnings were going to be better, but now we just have this, rate cuts are going to have a limited impact. Most regional banks are expected to report a sequential earnings decline in the fourth quarter of 2024, even though the Federal Reserve's interest rate cuts improved the funding cost challenges. Some 48 of the 65 publicly traded banks with assets between $10 billion and $100 billion as of September 30th, 2024, are estimated to post lower earnings per share quarter over quarter, according to S&P Global Market Intelligence analysts of consensus estimates of banks that have coverage from at least 5 analysts. About 1/5 or 14 lenders are expected to report higher earnings sequentially, and 3 are expected to report no change. So again, not great on the regional bank front. But let's see here. Analysts are bullish on U.S. bank earnings ahead of the fourth quarter 2024 report. So here we have an article from Monday that basically say analysts forecast broadening earnings momentum for big U.S. banks in the fourth quarter of 2024 as net interest income lifts off troughs reached during the year, with potentially light regulatory touch under the incoming Donald Trump administration poised to deliver another boost. Yes, hopefully, but I want people to keep in mind what I started at the beginning of the live stream tonight, and I was talking about how the federal regulators have just been moving at breakneck speed to get all of their stuff rammed in. And, we have over 5,000 pages of new regulation just in the last few years. That is a tremendous amount of regulation there, and it is going to take some very heavy lifting to roll some of that back. And I don't know if all of it can be rolled back. More than likely, you probably get some of it rolled back. But there is a lot of regulation on top of banks right now, which is not making things easy. That is for sure. Okay, let's keep going here. So U.S. banks turn toward equity issuance and away from senior debt in the fourth quarter of 2024. The total value of U.S. banks' capital offerings declined sharply in the 2024 fourth quarter, but overall capital raising activity during the year outpaced 2023. Capital issuance for the fourth quarter of 24 totaled $4.04 billion, down 86% from the $29.59 billion in the previous quarter, and down 84.4% from the 25.7 billion in the year ago period, according to S&P Global Market Intelligence. The total value of capital offerings in the fourth quarter dropped to its lowest level since the third quarter of 2020. Overall, U.S. banks recorded 87 billion in total capital issuance in 24, up 22.5% annually, but still down from the levels seen in previous years. Now, why do you think that is? Well, because capital issuance is expensive. It's expensive right now. I'm sorry. I should say not equity issuance, but capital raising. So raising capital is expensive money right now. And so you can see here from this chart, quarterly comparison. So what do we have here? We have senior debt, subordinated debt, preferred equity, common equity. So these are your different types of capital raises. You could do debt, you could do equity, and you could just see here 2024. I mean, was just way lower than a lot of these years. I mean, the issuance of senior debt was almost non-existent in the fourth quarter of 2024. Subordinated debt much lower, and basically you're just getting preferred equity and common equity issuance, which was not all that much different from prior quarters, but definitely not as great. Senior debt, which typically makes up the bulk of issuance activity, drastically reduced to just 22.5 million in the fourth quarter, almost a 100% decline from the previous quarter and the year ago period. Total senior debt issuance for the year stood at about 70 billion, up from 62.5 billion of such issuances in 23. Conversely, common equity offerings experienced a robust increase due to higher bank valuations following U.S. elections. Banks recorded a total of 4.46 billion in common equity offerings in 2024, up from 3.92 billion in 23. And we got the stuff in here. So let's look at. All right. And then we got some other news here. But yeah, so basically, it's just good. It's just important to note here just the equity issuance, and they're just the move away from senior debt. We're going to have to see if senior debt makes any kind of a rebound here in the first couple quarters of this year. But we'll see. Definitely something to keep an eye on. So, and let's take it before I go on to some of the other news. I just want to shoot back to some of these other articles here I had here. So bankers bullish on deposit and loan growth over the next 12 months from an S&P survey. U.S. bankers anticipate an upswing in deposit and loan growth over the next year. The sentiment reflects the banking industry's positive outlook on net interest income and fading worries about credit costs. So the take, a little over 77% of respondents forecast deposit growth over the next 12 months. Approximately 83% expect loans to rebound over the next 12 months. And concerns about credit quality across all loan types decreased, except for commercial real estate loans. Rosy outlook on deposit growth. Let's see here. S&P Global Market Intelligence surveyed U.S. banking industry professionals between November 14th and December 13th and found that 77% of the respondents expect deposits to grow at their institutions over the next 12 months, up from 70% in the third quarter 24 survey, the highest mark since the fourth quarter of 2022. The U.S. banking industry recorded growth in total deposits greater than 1% on both an aggregate and median basis in the third quarter of 24. While the market anticipates fewer Federal Reserve rate cuts than they did a few months ago, industry analysts said the outlook on net interest income still looks quite positive, given deposit performance and better reinvestment rates. The proportion of respondents expecting a drop in consumer deposits at their institution over the next year decreased sequentially by 14.5 percentage points to 24.8%. Similarly, survey participants expected a decline in small business deposits, decreased 6.9 percentage points on a sequential basis to 11.9%. So there you have some interesting data there. So they're kind of bullish on loans over the next 12 months. And then let's see here. And all right, let's see here. I'm just thinking, do I want to do a couple things here before I get into some of these other things? Because this is more kind of like a lot of the rest of the stuff I have here is more like general news. I do have some other articles on some of the main things like inflation and stuff like that, but that was kind of the bulk of a lot of the more hardcore banking data and news. A lot of the stuff is more just kind of like headline information here. And this is really interesting. This gets into the whole fires out in California and stuff like that. But there's a couple things I always do, and I want to get back to that. So I'm just going to pop out for just a second there. So I'm going to give everybody the economic, I always like to give everybody the economic indicators coming up for the week. I also like to talk a little bit about the banking episodes that I had out for this past week. So I want to go over that real quick. And then we'll get back to some of this other news here. Okay. What do we have for economic indicators coming out this week? So obviously Monday, market stuff is closed because of the MLK holiday. Tuesday, nothing really coming out. Then Wednesday, January 22nd, we get the U.S. leading index. We get the 20-year Treasury bond auction. We get the API weekly crude oil stock. On Thursday, January 23rd, we get the continuous jobless claims and initial jobless claims. And then on Friday, January 24th, we get the manufacturing PMI, services PMI, existing home sales, Michigan consumer sentiment, and the U.S. Baker Hughes total rig count. So not a ton of economic data coming out this week, but definitely getting a bunch of information there on Thursday and Friday as far as like the labor market, manufacturing, consumer sentiment. So we will continue to keep an eye on some of those things and see how some of that data and information comes in there. Okay. So what were some of the episodes that I had come out this week? So I did have a snafu on Thursday. For some reason, one of the episodes that I posted up, the video got wonky and I had to take that thing down on Thursday, reshot the video, and that will be coming out on I'll actually be using that one on Monday. And that was all about the ICBAs, the Independent Community Bankers plan for the new Congress and the new administration, how they intend to their new what is it? Reform. I forget what it's called. Basically just working on just trying to fix a lot of the regulatory issues out there at the moment. We'll just just leave it at that. But so that episode got messed up on Thursday, so that will be coming out on Monday. But let's go back to last Monday for a second. So I had probably one of the most important episodes that I have done to date, and that is I did episode 298, which was the 1033 rule, aka open banking update. And that episode was a little longer. It was almost about a 30-minute episode, but I try to walk through a lot of the history on open banking. Open banking it's an enormous topic for right now. It is going to become the major thing this year and next year. We probably have the fight of all fights from a consumer perspective to try to get this thing to not happen. There are some lawsuits out there right now, but I think there needs to be a lot more. And the problem with the open banking thing is that it's just like the beneficial ownership information. Like you have so BOI came from the 2021 Corporate Transparency Act, the CTA. And who passed that? Oh, well, that got passed with a bunch of Republicans. And so, and conversely here with the open banking thing, you apparently have a lot of bipartisan support for this on both sides of the aisle. The problem is that nobody has really talked about these things. These are all things that, the CTA was obviously a bill that got passed, and then the regulators do what they do. They just take it, interpret it how they want, and then just roll with it from there. And also, and two, I don't think people really understood what was in the bill when they voted for it, which so sadly is so typical of what happens today. with a lot of these bills that go through. I'm always haunted by Nancy Pelosi's famous comment. Well, we have to pass it to know what's in it. Which is just ridiculous and absurd. And I truly believe like 90% of the problems that we have is because all this stuff gets jammed into these bills. And this is really why you need single purpose bills. You need single purpose bills so that you don't get these surprises. You don't get this nonsense that jumps up on you, and it comes up, and then you need new legislation to counteract the old legislation that was put through that caused the problem. So you end up on this hamster wheel that just forever keeps going round and round and round. But open banking, is a major issue, and it's not a law; it's a rule. Open banking is a rule that was put out by the CFPB, but the similarities between BOI are the fact that people don't really know anything about it, and if people really knew and understood it, they wouldn't want it. And that's why, you haven't seen this big push. That's why there hasn't been this big public push, because they want this thing to fly under the radar. They want it to fly under the radar until it's basically implemented, and then it's too late. And then it's implemented, and then it's like, gee, shucks, guys, it's implemented. There's really nothing we can do. You're kind of stuck. Too bad. We just have to live with it now, And so I'm trying to get the word out about open banking. I'm trying to get people to understand what it is and why, as a consumer, you would not want this thing. So please, I cannot, ask people enough. Go and watch episode 298, the 1033 rule, aka open banking update. Go watch that episode so you can understand open banking and be able to understand why you don't want it. And basically go out there and hopefully tell other people about it, because this thing is now put in place. It is supposed to become a reality in 2026. We are very quickly running through that. The ICBA just put out their open banking guide, which I'm going to cover in more detail. And they give a lot of great information in that guide, but it also comes with kind of this attitude of like, well, this is going to happen, so we just have to deal with it. And I, do not believe that this is a foregone conclusion. I do not believe that this is just automatically, going to happen now just because the CFPB says it's so. But anyway, okay, so that's kind of the diatribe there on open banking. So the other episodes I put out this last week were episode 299, how to make cybersecurity part of your bank's culture. So the previous week, I did effective use of enterprise risk management in episode 296. So it was kind of like, how do you culturally incorporate enterprise risk management into your bank or your company? And so this week's was kind of on cybersecurity. How do you make cybersecurity part of your bank's culture? So again, I thought that was a good episode, a lot of good tips and stuff in there. And then episode 300 was an update on international banking. I just wanted to say I had a number of things there on like Canada, France, Japan, China, what was happening in international, what's going on overseas. Because again, most of the stuff I focus on is on the U.S. domestic market. I wanted to kind of take a step back and just say, okay, hey, what's going on internationally? I did some episodes a few months ago on like Japan and China and what was happening there. So I just wanted to kind of get an update on that. And then episode 302 yesterday on Friday was a crypto industry update, and that was a continuation of the ongoing crypto series. So this was crypto series part 14, and I covered a number of things in there. Covered a number of different crypto scams, different things that are going on there. Looked at some of the kind of fluctuation in Bitcoin. Talked about the number of Bitcoin that are out there and why it is the number of Bitcoin is going to continue to shrink. And, we covered a number of crypto related industry topics in that episode. So like I said, if you're watching the crypto series, if you're enjoying some of those episodes, definitely go and check that out. So there you go. So those were the 4 episodes that came out this week. I will have 5 new episodes coming out. The 3 of them are already done. 2 of them I'm still kind of working on a little bit. But keep an eye out. Monday, like I said, on Monday, I'll have ICBA's plan for the new Congress. That episode will premiere on Monday. And then, episodes the rest of the week, Monday, Tuesday, Wednesday, and Friday. So, okay. What do I got here? Okay, let's go back to this for a minute. So, more than 1.72 billion of commercial real estate within Palisades, Eaton, Hearst fire perimeters. 3 significant wildfires are burning around Los Angeles, spanning more than 38,000 acres, and they could affect commercial real estate in the area. The Hearst fire, the smallest of the 3, is largely contained, according to the Department of Forestry and Fire Protection. According to S&P Global Market Intelligence analysis of county-level property records, nearly $1.72 billion worth of commercial real estate falls within the Palisades, Eaton, and Hearst wildfire perimeters, with that figure continuing to grow as the fires spread. S&P Global Market Intelligence identified more than 1,400 commercial real estate properties within the current perimeters. Recent assessed values of the properties totaled nearly $1.72 billion, with $517.8 million having mortgages attached. Some of the most expensive commercial real estate properties in the fire's perimeters included the Getty Villa Art Museum and the Palisades Village Shopping Mall. Now, I do know the Getty Villa Art Museum was fine. I do know that they had put in a bunch of safety measures, fire suppression things. And so I know that the Getty Villa is okay. Real estate investment trusts have limited exposure to the wildfires, with only a single REIT-owned property within the wildfires' current perimeter. That being said, more REIT-owned properties in the nearby area will be at risk should the fires continue to spread. So we just have a lot of issues here with this fire. Yeah, it's just, but I just thought that this was interesting, just from the value and the total number of properties. I mean, it's just absolutely, it's hard to get your mind around this catastrophe and the sheer utter damage that has been done here. Obviously, the political fallout from this whole thing in California will be massive, and there will be a lot of shakeup in politics in California in the next couple of years. You just can't get around this. I mean, people's homes, their lives have been destroyed, and it's just terrible. It's just terrible, and I think a lot, and there's no doubt a lot of it was preventable. Well, like I said, I'm not getting into all that, the kind of politicalness, that political topic, if you will. But it's just crazy. And like I said, and we'll be getting more information like this around the values of the residential and the commercial properties, the number of properties lost. We've seen insurance estimates out there. Some of them are $250, I think $300 billion to fix all this stuff. So, just crazy. So, all right, let's take a look. These next 2 articles are some of the top performing banks, community banks in the country. So I just thought these were kind of interesting. I thought I'd share this to everybody. So Stride Bank tops 2024 best deposit franchises among large community banks. Banks with high concentrations of non-interest-bearing deposits proved to have the most enviable deposit franchises in S&P Global Market Intelligence's inaugural deposit rankings of institutions with $3 billion to $10 billion in assets. And number 1 was Stride Bank of Enid, Oklahoma. It has 11 branches, gross loans and leases $3.17 billion, total deposits $3.43 billion. Number 2 was First Community Bank Shares, Bluefield, Virginia, 58 branches, gross loans and leases $2.44 billion, total deposits $2.66 billion. Amalgamated Financial Corp, New York. This is an interesting one. 6 branches, gross loans and leases $4.59 billion, total deposits $7.6 billion. Now, I will tell you that Amalgamated Financial Corp had at least as far as I knew as of last year, was having a number of issues. With their loan portfolio, with securities. They weren't looking so hot. Like they might have had this for, top franchises by deposits, 7.6 billion. That 7.6 billion is because they have a ton of, I believe, union deposits and Amalgamated Financial Corp. I'm pretty sure they have a ton of union deposits. It's a very concentrated, a lot of concentration risk there. I would say that, Stride Bank, who got first, and First Community Bankshares, who got second, are probably look like the epitome of like kind of your typical community bank, well-balanced financial institution, well put together. Amalgamated, not so much. I'm, maybe the numbers on this list bear that out, but I don't. I'm a little on that one. We all heard of, we all knew the problems with Community Bank of New York, CBNY. They had all kinds of problems, had to be bailed out, had to raise $1 billion in capital to get them straightened. And when Community Bank of New York was having all their problems and really looking, they were teetering. Some of the other banks, there was probably about 5 or 6 other banks I was looking at that time, basically saying, I wonder who could be next here. And I could tell you Amalgamated was on that list. And I was like, I wonder. So I don't know. Interesting. We'll see there. All right. Next thing is Titan Bank tops 2024 best deposit franchises among small U.S. community banks. So these rankings put a premium on less rate-sensitive franchises through the recent tightening cycle. Institutions that were less reliant on borrowings and certificates of deposit for funding, and those with more efficient operations. Deposits represent the true value of a banking franchise, and evaluating the quality of deposit franchises now is opportune, since the Federal Reserve pivoted to lowering rates just a few weeks before the third quarter of 2024 ended. Analyzing different deposit franchises at this point in the rate cycle highlights which banks' deposits perform the best during the Fed's tightening cycle. So number one was Titan Bank in Dallas, Texas. They have one branch, surprisingly. Gross loans and leases, $296 million. Total deposits, $615 million. Not too shabby. Second bank was Western Bank, Artesian, New Mexico. Again, one branch. I guess all three of the top three branches here have one branch. Gross loans and leases, $146 million. Total deposits, $340 million. Very nice. Third bank was Tejas Bank, also in Texas. Just one branch. Gross loans and leases, $123 million. And total deposits, $209 million. So again, well done. So very, very good job here by the three banks here finishing in these top three, and kudos to those banks out there. Job well done. I hope all those banks just keep growing and keep prospering in the year ahead. And now let's run through some other news here. So surge in healthcare employment may mask weakness in wider U.S. jobs market. Yes, I've been saying this. So when you come down here to the jobs report, when you break down the jobs report, you basically see that the vast majority of jobs over the last year has been from number one, the government. Number two is healthcare. And the reason why healthcare has been so good is because the government has spent a lot of money on healthcare. They're getting a lot of subsidies from the federal government. And that is what is driving a lot of these jobs. And you can see here, state government, local government, federal government, private education and health services right there at the top, boom. So if the question becomes, if the government spending gets cut and maybe a lot of these healthcare companies aren't getting as much in subsidies, what happens there? So again, something we absolutely have to keep an eye on. Let's see here. Late surge pushes 2024 past prior year for 10 billion plus M&A deals. So M&A deals saw a big, large global M&A pickup in 2024 with 29 deals of 10 billion or more in transaction value announced throughout the year compared to 24 in 2023. So a little bit of a bump there in large global M&A transactions. Institutional selling hits 2024 peak in December. So institutions continue to aggressively sell equities through the end of 24, but capital kept flowing into index and exchange traded funds and passive broad-based investment strategies. So you can kind of see how institutions, hedge funds, retail, and index and ETF, this is the net capital flows. So little bit of money going into hedge funds here in December, retail going negative, institutions going negative, but then index and ETF, not doing too shabby there. So, okay, investors' appetite softens in January as policy worries take hold. So while U.S. investor optimism extended into a third straight month in January, risk appetite softened amid concerns about interest rates and government policy, according to the monthly S&P Global Investment Manager Index survey released on January 14th. So you can see risk appetite weakens at the start of the year. So definitely some concerns out there on the part of investors. Short sellers target Japanese regional banks in the fourth quarter of 24 amid margin pressures. So smaller lenders from Japan dominated the list of the most shorted banks in Asia Pacific in the quarter ended December 31st, 2024. So that is something we will definitely have to keep an eye on. Private equity-backed mega deals jumped higher in 2024. So private equity mega deals surged in 2024 as firms took advantage of improving M&A conditions to put the industry's massive stores of dry powder to work. Private equity firms announced or completed 18 mega deals valued at $5 billion or above in 2024, more than double the prior year total and the fourth highest annual tally of QE-backed mega deals since at least 2000. So you can see here definitely a nice jump there in global VC-backed mega deals since 2000. U.S. public energy companies record highest median default risk at 24 end. The energy sector recorded the highest median odds of default at the end of 24 as risk scores were mixed across other sectors, according to data from S&P Global Market Intelligence Risk Gauge Model. The probability of default was 6.62% for the median publicly traded U.S.-based energy company as of December 31st. The score was unchanged from the end of the third quarter of 2024. Across other sectors, the median probability of default scores fell in 5 sectors and rose in 5 others. So other communication services were a little on the high side. Consumer discretionary, healthcare, industrials kind of got, financials, real estate were on the lower side, utilities, but it really see a big jump up there between utilities and consumer staples. So kind of interesting there. Okay, and then what are some kind of banking news things, like what's happening with some other banks out there? So M&T cleans up their real estate books as borrowers move during refinancing window. So M&T Bancorp expects further improvements in its criticized loans, though at a decelerating pace if medium and long-term interest rates stay high. So M&T trying to clean some things up there. This is an interesting one. TD Bank CEO to step down. Toronto Dominion Bank is speeding up the move to new leadership and overhauling its board, with Chief Executive Bharat Masrani leaving the post 2 months earlier than planned, and Chairman Alan McGibbon set to step down as the lender looks to put behind it the scandal of failing in its anti-money laundering system. Now, I don't know if it says it in here, but I had read somewhere else that they basically apparently had cut his salary by 89%. I guess that's what happens when you blow up your BSA and your AML office, and your bank gets like the largest fine in history of over $3 billion. So Chief Operating Officer Raymond Chun will take the CEO post on February 1st instead of April 10th. Masrani will remain as an advisor until the end of July, helping with the Canadian bank's anti-money laundering remediation work. McGibbon plans to step down as chairman and resign as a director by December 31st, but will continue to guide the bank and support the incoming CEO while a search for his successor is undertaken. Several other directors will also step aside as TD Bank makes changes to its governance policies. For the past year, the Canadian financial institution has been operating while under investigation in the U.S. The bank pleaded guilty to multiple charges in October for failures in its anti-money laundering program, agreeing to pay $3.09 billion in fines and accepting limits on growth in the U.S. That's called the asset cap. So Wells Fargo operates under an asset cap since their whole sales scandal, and now TD Bank is going to operate under this asset cap as well. So definitely some interesting news there. This was a great one. Grunberg warns against regulatory complacency days before planned resignation. So this is rich. Mr. Martin Grunberg, who presided over the biggest scandal in the history of the FDIC, just this the sexual misconduct, all the crazy things going on there. And if he was the CEO of any company, any publicly traded company, he would have been fired immediately. And, but of course, because it's government, and, this guy basically has hung around here for the last 8-9 months. And now he's telling us, of course, on the way out the door, how important it is to, to just keep driving through massive regulation, especially this completely misguided Basel III endgame, systemic risk exception, so yeah, I would just say thank you, Mr. Grunberg. We'll take it from here. Thank you. Goodbye. Go. I'm sure he'll get a nice cushy job on some board of directors somewhere and make buku bucks, but whatever. Okay, a couple of JP Morgan articles here. JP Morgan Chase still looking for better prices to deploy capital. So JP Morgan Chase believes that rich asset prices across markets mean it is still wise to wait to deploy its large capital stockpile, but its surplus has reached a point where it is likely to increase share buybacks, executives said. We feel very comfortable with the notion that it makes sense for us to have a nice store of extra capital in light of the current environment. We think it's important to acknowledge the tension in the risks and uncertainties in the environment and the degree of optimism embedded in asset prices and expectations. However, with another quarter of return on tangible common equity of about 20% and its Tier 1 common equity ratio growing another 40 basis points sequentially to 15.7%, we have enough excess capital. And unless we find in the near term opportunities for organic deployment or otherwise, it means more capital return through buybacks, all else being equal. So kind of interesting there. So JP Morgan is sitting in a very good place capital wise. And then here's another area. So JP Morgan to appoint Jennifer, if I'm saying this right, Piepzak as COO. Race for next CEO is in chaos. So JP Morgan Chase, the largest bank in the United States, announces on the 14th that Daniel Pinto, President and Chief Operating Officer, will step down on June 30th, and that Jennifer Piepzak, co-CEO of the Commercial and Investment Banking Division, will be promoted to the new CEO. Jennifer will take up the role of COO on the 14th, and the two COOs will run side by side for the first time, being as a transitional period. Daniel Pinto will become vice chairman after stepping down as COO and will retire at the end of 2026. He will become sole president and COO, why does it say he will become sole president and COO in 2022 and support CEO Jamie Dimon as the number 2? I think that was misworded. Jennifer has worked at JP Morgan for 30 years, mainly in the investment banking field. He has also served as Chief Financial Officer, CFO, and co-CEO of the Consumer and Regional Banking Division and will serve as co-CEO of the Commercial Investment Banking Division from 24. The major concern in the U.S. financial world is the successor to Jamie Dimon, who became CEO of JP Morgan at the end of December 2005 and has led the company to become the largest bank in the U.S., surviving the Lehman Brothers crisis and the COVID-19 pandemic. Jennifer, who will serve as CEO, has long been considered one of the leading candidates. However, a company spokesperson told Niki that Jennifer has clearly expressed a preference for a role in senior management supporting the management team and said that she does not wish to be considered for the CEO at this time. The possibility of her being selected as Jamie Dimon's successor has decreased. Other leading candidates include Marianne Lake, CEO of Consumer and Regional Banking, and Troy Rowerbog, co-CEO of Commercial and Investment Banking. Doug Pinto, who will succeed Jennifer as co-CEO of Commercial and Investment Banking, and Mary Erdos, CEO of Asset Management and Wealth Management, are also potential candidates as senior executives. Whenever Jamie Dimon was asked how long he would remain CEO, he would jokingly answer 5 more years. But in an investor briefing in May of 2024, he said, not 5 more years anymore. The company is training and selecting successors by rotating senior executives in their roles every year and pitting them against each other. That's interesting. Jamie has done an amazing job there. He has, the guy is a legend. He has cemented himself forever in the banking textbooks. This period of the 21st century, at least the beginning of the 21st century here is Jamie Dimon is the man. He is the biggest name in banking, runs the biggest bank in banking, the biggest, baddest bank in the world. And he's got a lot of he's done a lot of amazing things there as CEO. But hey, look, somebody's got to step up and take the spot, right? Somebody's got to step up and become the CEO. And I would be surprised if I would not be shocked one bit if toward if in the second half of the year that they basically make the statement that that the successor will be named and that Jamie will step down by the end of this year, because he started in December of 2005. If he steps down in December of this year, that basically puts him 20 years as the CEO there at JP Morgan. I'm sure in his mind, he's probably thinking, hey, nice round number. I'll wrap it up at that. So I would not be shocked one bit if that's how this kind of plays out. But we shall see what happens. So, all right, I'm going to kind of skip that one. AI continues to add pressure on the job market. Yeah, we kind of know that. CPI inflation hurt more in December, but with the silver lining, we kind of talked about that earlier. High inflation is entering its 5th year. Yep, we know that. Inflation is set to run above the Federal Reserve's 2% annual target for a 5th year if projections for 2025 hold true. Yep, that is true. We talked about it earlier. Jamie Dimon says 2 significant risks loom over the U.S. economy. The 2 big risks threaten a resilient U.S. economy. Jamie Dimon said ahead of next week's scheduled inauguration of President Trump. Let's see here. Ongoing and future spending requirements will likely be inflationary, and therefore inflation may persist for some time. Additionally, geopolitical conditions remain the most dangerous and complicated since World War II. Yes, I mean he hits both right. He hits both nails right on top of the head. Like we need major spending cuts. Again, if it was me, if they were asking me for for whatever my 2 cents is worth, I'm just some wacky guy on YouTube, right? I think for whatever it's worth, I think you got to cut $2 trillion. You got to try to get back to a balanced budget. If you seriously want inflation to come down, you got to cut $2 trillion. You got to cut this massive, the deficit spending has to end. You basically, in order to get the national debt under control, you have to get the fiscal policy every year under control. We have to pass a balanced budget. We can't continue to spend more than we're bringing in. That's just step one. That's like step one, like stop the bleeding. If you could get spending back to a balanced budget. You could cut that $2 trillion of waste out. Then if you could do that, then, things would probably get back to normal in a hurry. See what Milei is doing, down there in Argentina. But will they be able to get $2 trillion of cuts in? Probably not. Again, as sad as it is, if they could somehow get, 3, 4, 500 billion of cuts in, I think that's probably more likely where you're at. That's probably more likely where you're likely to fall, at least in the short term. But we'll see what happens there. But obviously, the geopolitical concerns are massive. That goes without saying. Okay, JP Morgan Chase, their fourth quarter results topped estimates as investment banking fees surged. So, JP Morgan had good fourth quarter results there. The world's biggest bank by market capitalization reported profits of $14 billion on revenue of $44.77 billion. So that's great. Good for them. Rocket and rolling. Citi swings to a profit and announces $20 billion stock buyback. So Citi reported fourth quarter results that exceeded expectations, sending shares higher in pre-market trading. But I would say, their CEO is going on a massive cost-cutting binge right now, trying to cut all kinds of costs at Citi. So a lot more, I'm sure, to come this year on updates on Citibank. How's Goldman Sachs doing? Goldman Sachs stock rises as bank exceeds fourth quarter estimates. So Goldman Sachs shares gained in pre-market trading after the bank reported better than expected fourth quarter results. The bank reported $4.11 billion in profits on $13.87 billion in revenue, well above the respective $2.89 billion and $12.31 billion that analysts estimated. So Goldman Sachs continues to roll along. Okay, this is kind of interesting. So last week, I did on an episode last Friday, episode 297 was Lessons from Warren Buffett. And I kind of covered this new book that came out on Buffett's early years. And then when I happened to be scrolling through the Wall Street Journal, I saw this article that I thought was interesting. So Warren Buffett prepares his middle child for the job of a lifetime. So Howie Buffett will become the non-executive chairman of Berkshire Hathaway, charged with keeping the culture and making sure the CEO does too. So Warren Buffett, who is 70 years old, by the way, it's kind of interesting. I don't know if anybody's ever seen the movie The Natural with Robert Redford, but it's one of my favorite movies. And Robert Redford comes into the dugout, and basically he's a young kid. He gets hurt. And then he's out of baseball for 16 years, and then he decides to get back in it, basically at his late 30s. And so he walks in, and the manager looks at him and goes, son, he goes, ball players, they don't start at your age, they retire. And that's what kind of entered my mind when I heard that Warren Buffett's 70-year-old son was gonna take over as chairman of the company. I was like, really? It's at 70? He's gonna take over now at 70? Well, Warren's like 157. I mean, no, he's not that old. He's 90. I think he's 94 or 95, but he feels like he's 157 years old. I feel like it seems like he's been around that long. But yeah, just an interesting article. It talks all about Howie Buffett, his life. Yeah. Warren Buffett is 94. He's 94 years old. But yeah, 70-year-old Howie's gonna take over. So I thought, just like I said, thought that was interesting thing to share there. This is really interesting, and and this came up because of the financial history series I'm working on. One of the topics I'm going to cover is the rise of BIZ, the Bank of International Settlements, and there is a story there. I have a book that's going to connect to the episode called The Tower of Basel, and it is mind blowing what what the central banks and what the Bank of International Settlements did with the Nazis during World War II. And I happened to see this article this week in the Wall Street Journal. Nazi ties to Credit Suisse ran deeper than was known. Hidden files reveal. Fresh look at archives unearthed Nazi-linked accounts discovered by bank in the 1990s, but never disclosed to investigators. So there was this big investigation in the 1990s that unearthed all these basically Nazi ties to through Credit Suisse, and undoubtedly with Credit Suisse's with their failure, and because they got bought by UBS. UBS also had ties to Nazis and Nazi banks and the Nazi central bank, the German central bank. But that is a crazy story. And I cannot wait to tell it because I think people are going to be fascinated by this because this is all banking. This is all from a financing banking perspective. And while there are countless things on World War II out there, there's endless documentaries about the war, the fighting, the generals, the leaders, the countries. I mean, everything involved. But you very rarely hear something about the financial aspects of World War II. And that's why I think this is such a great and fascinating story. So anybody who loves history or loves, banking history, financial history, I think they're going to absolutely love it. So definitely more to come. When I get to that episode, I will absolutely go over this article. I'm going to save this for now. But when I get to that, definitely coming back to this. So, all right, we talked about that earlier, and then bond yields are surging around the world. We talked about that, and then just a couple of things real quick here to wrap up. I want to show you guys some things on China real quick, and then just a couple of things here on the job market. Now, I did an episode a couple weeks ago on the January 7th. I did episode 294, which was the labor market going into 2025. And what were some of the things happening there with the labor market? So these three articles are just to kind of give you an overview, like kind of paint a picture of what's happening right now. So we got these fake job postings are becoming a real problem. 1 in 5 jobs advertised is fake or not filled, according to a new analysis, more soul crushing than ever. And where is the bulk of these fake job postings? It's in white collar jobs, higher paying jobs. This was one of the things that I actually talked about last year. I did an episode on ghost jobs, where literally it's estimated that so in other words, if you have 8 million open jobs, right? Probably half of those are fake. They're not actually real jobs. They're fake job postings known as ghost postings, where companies put up a post for a job that they never actually intend to fill. So this is still going on. This is still becoming an issue. And I think that as the number of job openings decreases and as it gets harder and harder to find white collar jobs, the fake job posting thing is going to become a bigger issue. And I wouldn't be surprised if some point it gets cracked down on to the point where it's like, hey, look, we got to just stop this. We got to stop companies from just putting out these basically BS job postings. Okay. Unemployed office workers are having a harder time finding new jobs. More than 1.6 million unemployed workers have been job hunting for at least 6 months. So the U.S. economy has added more than 2 million jobs over the past year, but more people who are out of work are having a hard time getting back in. That's because, the white collar jobs, the better paying jobs. As of November, more than 7 million Americans were unemployed, meaning they didn't have work and were trying to find it. More than 1.6 million of those jobless workers had been job hunting for at least 6 months, according to the Labor Department. The number of people searching for that long is up more than 50% since the end of 2022. Now, here's an interesting thing as a sidebar. I talk all the time about the different labor market economic indicators that are out there. And the media loves to use what's called the U2. The U2 is, that's the 4.1% unemployment rate. I prefer the U6. The U6 gives you a much more accurate. Now, all these people who were looking for jobs that have been looking for 6 months, they will now wait for it, they will fall off of the U2. They will fall off of that to make those employment numbers look better, but they will all remain on the U6, which the U6 basically is showing like a 7.4% unemployment rate right now, which coincides with this number, which I believe is the real unemployment number, if you will, that's out there. So like I said, and that just to understand that as a sidebar. So the number of people searching for that long is up more than 50% since the end of 2022. On average, it now takes people about 6 months to find a job, roughly a month longer than it did during the post-pandemic hiring boom in early 2023. The pain is largely in high-paying white-collar jobs, including in tech, law, and media, where businesses grew fast when the economy reopened from the pandemic, but now have less needs for new hires. So, just interesting to note. And then the last one here is even Harvard MBAs are struggling to land jobs. The latest crop of elite business school graduates are taking months to find new jobs. Landing a professional job in the U.S. has become so tough that even Harvard Business School says its MBAs can't solely rely on the university's name to open doors anymore. 23% of job-seeking Harvard MBAs who graduated last spring were still looking for work 3 months after leaving campus. That share is up from 20% the prior year. During a cooling white-collar labor market, the figure was 10% in 2022. Now, I will say this. Here's a little bit of a caveat there. Harvard and the Ivy League schools have done a lot of damage to themselves in the last couple of years. A lot of damage to themselves. All the DEI, the woke stuff that's going on at these schools. They have really, a lot of people feel that they have turned themselves not so much into elite public education and not into elite private education, but to more indoctrination stations. And I believe that is bearing fruit, not bearing fruit. It is bearing true as these people come out into the workforce. And so, the bloom, if you will, is off the rose. And I think there's a lot of employers out there that because of what they're seeing from a lot of these Ivy League schools, they won't touch Ivy League. They won't touch a lot of kids coming out of these Ivy League schools because they're tainted. They're tainted. So, and again, I'm not saying that's what's happening in the majority of cases, but I do believe that that's real. I do believe that is a real thing. I do believe that if you're looking at job applicants and you see somebody from Villanova or Duke, and then it's like Harvard and Princeton, I think that whereas before people would say, oh yeah, Harvard and Princeton, no question. Now I think there's probably some hesitation. I think that's like, well, hey, let's look at those guys at Villanova and Duke. Let's maybe we need to take a look at them and bring them in and see what, because they're worried about some of the thoughts and attitudes coming out of some of these Ivy League institutions right now. So I think that's part of what is playing into this a little bit here. And then but I digress. I'll go on. And so last two things here. So these are with China. And this is basically say China reins in its once freewheeling finance sector with purges and pay cuts. Xi's campaign against capitalist access ushers out internationally experienced financiers for a new generation of loyal functionaries. Now, this is a little bit of a longer article. I'm not really going to get into all this, but this is a big problem. And I want to jump through just for a second. Let's jump to the other article. So this other article is Xi Jinping muzzles Chinese economist who dared to doubt GDP numbers. Gao Shanwen questioned Beijing's ability to boost its economy as threats loom from a property meltdown, burgeoning debt, and other challenges. At a Washington forum last month, a prominent Chinese economist raised doubts about Beijing's economic management and said China's economy might have grown less than half the roughly 5% pace flaunted by authorities. When Xi Jinping found out, he was furious. According to people familiar with the matter, the Chinese leader ordered an investigation of Gao, chief economist at state-owned SDIC Securities, who has frequently advised the government on economic and financial policies. Xi then ordered authorities to discipline him, whatever that means. Two comments that Gao made from the forum, hosted jointly by the Peterson Institute for International Economics and a Chinese think tank, angered Xi. Basically, he questioned the data. Coming out of China, and I think these are two big things. Number one is, and I've always said this: how do you believe anything that comes out of, like, why would you invest in a Chinese company? They don't operate like in the U.S. We have the Finance Stability Board. We have the the Finance Governing Board. We have generally we have GAP, general accounting principles. If I'm remembering, I've kind of drawn a blank on that at the moment. But we also have the other organization, the Accounting Financial Standards Board, the AFSB. They don't have any of that stuff in China. They might have some kind of board or something over there, but all I'm saying is that they don't have that like infrastructure of regulation around them that you would, continue to have trust in the stuff that's coming out of there. And that's just from a company level. Now we get to the government level, and you get an economist out here who's just trying to tell the truth. And Xi Jinping loses his mind and says, "Oh no, you got to go discipline that guy." Which, I don't know, they throw him in jail. Who knows? And that's going to have a chilling effect on economists and what they're saying or not saying coming out of China. And then China's economy, they have I've said it before, they have the largest real estate bubble in the history of the world, which has exploded. And they're entering into what most likely is a deflationary spiral, which is which would be brought on by the bursting of a credit bubble, i.e., their real estate market. And and things, I think the economy over in China is in really bad shape. And yet at the same time, Xi's answer to this is to rein in the finance sector because of capitalist access, And I think he's making some horrible moves. And I think China is going to be in a bad way here very shortly economically. Now, why is that a problem geopolitically? Well, it's a problem because, when you have a company that's run by communists or dictators or both, when they get into a problem financially, they usually start wars. That's what they do, because they need to take the citizens, because the citizens get mad about the economy, want them removed, want them gone. Okay, hey, thanks a lot. You screwed the whole economy up. Time for a new leader. And then they basically go, so basically they start a war to get people's minds focused on something else. So that's why I think all this is very alarming and very troublesome, what's going on in China here, because this could lead to bad stuff. I mean, because again, China takes over, they invade Taiwan or they take over Taiwan. That's World War III. That could be really, really bad. So again, I remain highly concerned about a lot of this. I think China is economy is in a really bad spot, and I think Xi is making some really bad moves here on this. So, but anyway. So, all right, that's all I got for everybody this week. Thanks for spending some time with me on this Saturday night. I hope everybody has a great weekend. Enjoy the day off on Monday for Martin Luther King Day. And like I said, just keep an eye out for the episodes I have coming up this week. And I will be back next, as always, I'll be back next Saturday night at 8 o'clock for another live stream of Strategy Room. And I thank everybody for being here. And I'll just wrap up by saying, hey, if you like this, please make sure to like, share, and subscribe, as that helps the channel. Please make sure to leave your comments, as I always love getting back to everybody. Remember, we are on YouTube, Rumble, and all major podcast platforms. Please check out some of the other content on the channel, and I will see everybody again real soon. Thanks a lot.